How to calculate. We're going to talk about here today. It's so easy. You're going to be like, man, why am I paying Josh the big bucks as a YouTuber to tell me this when I can figure out myself? Exactly. You'll be like, whoa. So the premise of this, I did a video the other day while I was driving my car. I was driving in my car. I turned on the radio. What was that song? I forgot. But anyway, it's something from back when I was growing up. You may or may not remember it. But anyway, and a lot of people said I'm a visual learner, as am I, and I need to see it on the whiteboard with our sunshine right there. Look at that. The sun and the great heat tab in the sky. That's just my overhead light there. One of these days I'll get a lampshade on it to cushion the blow. Anyway, so I said, okay, let's do this. So the point was I had a 60-40 portfolio. We'll run that on this calculation here real quick. It's easy when you figure this out. And my premise was when somebody is recommending a portfolio, and I'm using a 60-40 because that's kind of the what's that, traditional 4% rule is based on that, just the kind of ballpark. The standard operating procedure for most financial advisors is a 60-40 portfolio, 60% in stocks, 40% in bonds. And when so I was saying, look, when someone's recommending that, and then the first thing to say is, what do you expect? Your expected rate of return, and we can call that an EROR. EROR. See, E is a big one. Expected rate of return. Expected rate of return. I mean, it literally is semantics here, but expected rate of return. You have to have an expected rate of return whenever you're looking at investing, because an expected rate of return is what you literally expect to get. And this is going to be nominal. Nominal is before inflation. All right, so you got to make sure we're operating under the same the same definitions. Nominal, all right, equals before inflation. So you have real returns, which is after inflation. Then you have real returns, which is after inflation and taxes. Thornburg Investments used to do, and I imagine they probably still do, a graph of the real returns of various investment classes. I always thought that was fantastic, and I'm not sure if they still do it or not. I think they're out of Albuquerque, if I'm not mistaken. I'm not even sure if they're still around. But if you get a chance, go to Thornburg. It's a thorn, like you got a thorn in your side. Berg, B-U-R-G, Thornburg Investments, real returns. Maybe if I remember, I'll put it on the show notes. But that's a great chart because real returns is after inflation and after taxes, and that's all that really matters. But be as it may, we're talking right now nominal return, so before inflation. All right, so we're looking for our expected rate of return, nominal return. So we have two ways to look at this. Well, I guess many different ways, but generally, you'll have some guy says, look, I think you should get in a 60-40 portfolio. Here's what I recommend, and here's what it did. It did. And they'll say it did, I don't know, we'll just say 8%. Past performance. Now, now look, as much as we all chuckle, past performance is no indication of future performance, whatever the stupid thing on the prospectus that nobody reads. It's incredibly important for this stuff. Past performance is no indication of future success or future results, whatever the prospectus says. And the reason for that is quite simple, because the past is based on something completely different than we're dealing with now. The past is based on 5% bonds roughly and roughly 10% stocks. And I'm just using that for an example, all right? And we're not getting 5% bonds first and foremost. Now, whether or not whether or not we get 10% stocks remains to be seen. But very few prognosticators, which I follow and you should too, would say that we can expect similar returns going forward when valuations are pretty high. Now, that doesn't mean we can't. It just means if you look at history of the stock market, when the valuations are high, the future returns are low. When the valuations are low, their future returns are high. And the valuations today are not low. That does not mean they're bubble or nosebleed, because they're much lower valuations in stocks than bonds are today. A lot of people overlook that. So when people say, 8% is what you got in the past, we expect to get something along that lines. I say, what you first say is, how do you expect to get that? And I'm telling you, a lot of these people aren't going to have any. They're going to say, well, They won't know, and if they don't know, just get out of Dodge ASAP, because you're dealing with somebody who's not a student of the business. So here's what I do. I say I expect 7.5% on stocks. Draw it up a little bit more. 7.5% on stocks, and that's domestic. You know, probably 8% on international. But I'm just saying. But I don't want to get. I'm just looking at stocks. I'm looking at bonds. I'm using the U.S. If you want to throw some international in there for diversification, more power to you. It's not going to have much of an effect on your overall portfolio, because you're probably not going to have that much exposure internationally. So let's just set 7.5% stocks, and I'm saying 3% bonds. All right, so that's what I'm saying. 7.5% stocks, 3% bonds. Now, in a 60-40 portfolio, 60% of the portfolio is in stocks, 40% of the portfolio is in bonds. All right, so a couple things. That's what I'm saying, all right? Why do I say 7% stocks, 7.5% stocks? Because this is how you got to figure out. Earnings growth year over year plus dividend yield. Earnings growth year over year plus dividend yield. Now you could say earnings growth year over year would be 5%, and a 2.5% dividend yield, or you could say earnings growth year over year would be 5.5% plus a 2% dividend yield. Either way, it's 7.5%. I mean, that's literally how you factor this. Earnings growth year over year plus dividend yield. And if you look historically, the earnings growth year over year plus dividend yield has been almost identical to the nominal returns of the market. It's nuts, actually, when you think about it. And so that's what we're saying. Earnings growth year over year plus dividend yield equals your stock returns. Hope that makes sense. So you got to calculate, what do you expect the earnings growth year over year? Here's complete speculation. I just say 5 to 5.5%. I mean, why? Well, you can say historical averages of earnings growth are 6, 4, 5. You can do whatever you want. But I say 5% seems reasonable to me for earnings growth year over year. The dividend yield is anywhere between 2, with probably 1 3/4 on the growth stocks, 2 3/4 on the value stocks. So I'm looking at 2 to 2.5%. However you want to look at it, I'm looking at 7.5% earnings growth, 7.5% total return on stocks. Now, there's a let's see. Can you all see? I probably can't. So let me erase this a little bit. All right. So I want to erase something, because I want to show you what other people will say. And unfortunately, they are dead wrong. They're going to say there is some capital appreciation that can be added. All right, and this is where people make a huge, huge mistake. And this is why the issue of the price being the stocks being highly valued today, relative to historical norms, not relative to bonds, but relative to historical norms, can lead to a world of hurt. Because what's going to happen is they're going to say, okay, earnings growth year over year equals 5%, dividend yield equals 2.5, right? They're going to say 7.5%, but then they're going to say capital appreciation, which is actually an increase in price to earnings or a decrease in price to earnings. And a lot of these guys are going to say, we think we can get, if we think we're going to get 10% a year rate of return, that means we're going to get another 2.5% in capital appreciation, an increase in price to earnings ratio, i.e., people are willing to pay a higher price for that $1 of earnings. That is fleeting. That is fleeting. I'm just telling you right now, that number is fleeting. You cannot hang your hat on a continual capital appreciation and get a forward-looking projection. Because if you're saying capital appreciation at 2.5, that means you're going to say capital appreciation will go up infinitely, whatever it is, exponential, I don't know, it just keeps going up and up and up. And what happens as that keeps going up and up, because it's growing more than the earnings growth, the PE ratio keeps going up and up, and it's growing. And when the price of stock grows more than the earnings growth, the price of stock ultimately becomes in bubble territory. And when that happens, it starts going down. I mean, this is why you cannot look at capital appreciation as part of your metrics. You can't. Because if I'm sitting there saying, look, Mr. Smith, we think 25 years in retirement, I expect stocks to give us 5% earnings growth year over year plus 2.5% dividend yield. I expect you to get a 7.5% rate of return from now on. And he says, well, I expect 10%. And I say, why? He said, because I think I can get some appreciation on top of the earnings growth year over year. So think about that. So let's just say we're even Steven here. That earnings growth is here, but his capital appreciation is going above the earnings growth. And it's going to widen as we get further and further. It's going to get a bigger, bigger delta there. And at some point, it cannot continue on because the PE ratio will literally be in nosebleed. Well, not literally, but be nosebleed seats like we were in 1999. It cannot continue to do that. At some point, you're going to have a price to earnings decline, which is going to take all that capital appreciation away. I cannot tell you how many financial advisors don't understand that. They say, well, we should get some appreciation. It's just essentially the increase in your ability or willingness to pay more money for that dollar of earnings. Not an extra dollar of earnings, because we're only calculating that dollar of earnings and earnings growth year over year. We're saying between now and 25 years, on average, the stock market should give us 5.5% earnings growth year over year. Or 5%. I don't care. Whatever you want to do. That's not extraordinarily high as historical norms. It's not that big of a deal. But we're all saying we're only going to get 2.5% yield from now until 25 years. That might be on the low end, frankly. That's why I'm always calculating on the side of caution, not on the side of optimism. But let's just say they do increase cash flow, they do increase their dividend payout, which if they increase their dividend payout relative to the price to earnings ratio, that would give them a higher dividend yield. But let's just say they do that, but I don't know. We don't know. It's hard. You can't. That's speculation. You can't speculate to say we're going to expect between now and 25 years we'll get a 4% dividend payout, dividend yield. That's just complete speculation. Don't do that. So we use what we have today. We have a 2 to 2.5% dividend yield on the S&P 500. That's what you use. You say, okay, until things change, this is where I expect the market to be. 5% earnings growth year over year, 2.5% dividend yield. That's it. 7.5. Now, if someone else comes along and says we expect capital appreciation, they won't ever do that. They won't do that. They'll say, well, the historical norms have been 8% on a 60-40 portfolio. And you're like, but how did you get that? I'm just looking at the performance. They'll say, but how do you get that going forward? See, it's different. The past is not going forward. How did you get it going forward? If they give you 8% a year, then we have to have, and if they give you 8% a year, and this is on a 60-40 portfolio, but we're only getting 7.5% here. So if they're giving you 8% a year, they're saying 8% a year is what we expect going forward, and I'm only getting 7.5% on my stocks, then that means a 0.5% PE increase. That can't keep going on unless we're in a new era where 100 PE is normal. It's not. It's not going to happen. So that's how you get that. Now let's go to bonds. All right. I know it's confusing, but you got to understand that, which is why you really need to read John Bogle's book, Common Sense on Mutual Funds. And I'll put a link in the show notes. And if you buy it through my link, I get paid. I'm Johnny Manziel of YouTube. I get paid. It's a 4% commission, by the way. Just FYI, if you're wondering how much people get paid on these products on book, books don't cost that much. It's 4%. But I think some products pay more. I don't really pay much attention to it because I don't really recommend much. But prepping items and stuff like that, I think that's still all 4%. All right. So let's go to bonds. Bonds are even easier. A bond right now, let's just say, I always do this a million times Sunday. Bond is issued, at 100,000, 10 years, matures at 1,000. All right. It's got a 3% coupon, which is roughly what the average bond is doing right now when you factor in government and corporate bonds. The government bonds aren't doing 3%. They're doing half of that for a 10-year, but just a simplicity, which is why I'm still in the back of my mind. I think I might need to get my performance on my investments down a little bit because bonds aren't yielding 3% on the 10-year treasury. It's 1.5. All right, so I'm thinking about that, but we shall see. All right, so bonds, they got a 10% coupon, and so basically you buy here, it matures here, and you get your money back. All right, that literally you're loaning it to the company. 10 years from now, you're getting it back. It matures. All right, and it's not a sell; it's just a mature. It gets called. So anyway, you get 300. What's that? $30. $30. $30. All right, so you get $30 each year, each and every year, while that bond is out there. As long as the bond doesn't go bankrupt, that's what you're getting. You're not getting any more or any less. You know for a fact on your $1,000 bond, you'll get $30 a year times 10 years. You'll get, what's that, $300. I mean, literally, it could not be any simpler. So we know for a fact your return will be 3% a year. Now, bonds do not compound. I can't stress this enough. Bonds do not compound. I'm just telling you, you don't reinvest the bond income into that bond itself. It doesn't work like that. So you got to look at the difference between compounded, essentially simple interest, and compounding interest when it comes to bonds versus stocks. We're not going to get in that here today. But essentially what you'd want to do is you want to invest your coupon money into your stocks. All right, so and that way you can at least get compounding interest or compounding on your stocks. But just remember that you can't say 3% a year. Compounding doesn't work like that. 3% is simple. It's literally that simple. You get $30 a year, and it doesn't go back into that fund. It has to go back into something. Hopefully it'll be in the stocks to at least get some kind of potential for compounding. But you can't say 7.5% year over year for stocks compounding and then 3% a year over year for bonds. Simple. I mean, you can. That's what you should do, but you can't say both compounding because they don't. All right, so let's go back to the chart. I want to show you how we figure out then how do I expect my portfolio, given that right there, to perform on a 60-40 portfolio. Again, the math here is pretty simple, but I'm going to share it with you because a lot of people don't know how to do this. And because of that, they make mistakes or they get, they get sold a bill of goods by some ignorant person who doesn't know what they're talking about. Because they say the past performance, while it doesn't guarantee future results, can still tell us something. And it really can't, not in bonds in particular. All right, so here. So I say 7.5% on stocks, and we have 60% of the portfolio here, all right? And I say 3% on bonds, and we have 40% of the portfolio here. So what we do is we take 7.5 and we times by 0.6. We take 3 and we times by 0.4. Because 0.6 plus 0.4 equals 100%. That's my total portfolio. Does that make sense? That gives us 1.2. And then I need my trusty calculator to fill this other guy out. We got 7.5 times 0.6 gives us 4.5. Add those two guys together, and we got 5.7% rate of return on a 60-40 portfolio. And that seems maybe even a little bit high to me, simply because, that concerns me a little bit, but that's what we're going with. So we'd say a 60-40 should give us 5.7% nominal. All right, and that's what I would expect. Now, we can do the same if it's 80-20. We'd say 7.5 times 0.8 and 3 times 0.2. That gives 0.6. And I don't know what 7.5 times 0.8 is, so let's go ahead here. 7.5 times 0.8, that gives us 6. All right. So we get 0.6, and that would give us a 6.6% rate of return. So if you have a 80-20 on a portfolio where I expect 7.5% on stocks and 3% on bonds, I would expect a 6.6% rate of return from now going forward. A 60-40, I would expect a 5.7. And let's just do one more for giggles, all right? So now we'll say 7.5 times 0.4 and 3 times 0.6. It's 1.8. I don't know what 7.5 times 0.4 is, so 7.5 times 0.4 is 3. All right, so that's a 4.8% rate of return. So on a 40-60, 4.8, 60-40, 5.7, 80-20, 6.6. So if someone says I'm getting an 8% on a 6.4 60-40 portfolio, I just want to know how you getting that, buddy. How you getting that? Hope that helps. That's it, man. I'd love to hear your comments. Tell me where you think, you're crazy. I'm getting a whole lot better than that. Now, if you get better than that, that would attribute to two things. We could have prices on, like when the interest rates dropped, like someone was pointing on the channel the other day, bonds gave you 9% so far this year. Well, that's just because interest rates have dropped. That's a fleet that's going away. You're not getting that. You're not locking that in. And people say, well, I can sell it. Well, you can sell it, but then you got to buy something else. But trust me, everyone knows how this works. If you were to sell your bond that's up 9% and expect to get the same yield when you reinvest it in something else, it's just not happening. Because you and everybody else are paying premiums for bonds. I mean, that's just that's why this happened. Interest rates drop, the price of the bonds go down. You sell your bond for 9%, you take the proceeds. Well, now you got to find something to invest it in, and you're going to pay 9% premium over the bonds. It doesn't. That's how it works. So you're not locking in any capital gain. There's no capital appreciation on bonds. I mean, it's just not. You're getting literally what you see as long as the bond doesn't go bankrupt. Stocks could be different. We could have a higher year-over-year earnings growth. I wouldn't be surprised if we did. It depends on the election next year. I think if Trump wins re-election, I think China will heal. And when that happens, I think it's going to be a boom time. And I would absolutely expect earnings growth year-over-year to improve without question. We shall see. We shall see. If we're still in the midst of China's deception and lying to us and theft of IP, intellectual property, I think that's going to be bad. I really, really do. So someone had to stand up to these people, and it just took a long, long time for many administrations, both Democratic and Republican, for that to happen. But here we are. So if Trump wins re-election, China will slowly slide away into the ash pit of history for sure, ash heap of history, whatever, dustbin of history, as a communist used to say. And then we'll see more free trade, without question, more growth, without question. Vietnam, Malaysia, Indonesia, India will come to the forefront. It'll be fantastic. But we shall see. I'm not holding my breath on that. We don't know. But I think that could happen where you have an increase in year-over-year earnings growth. If not, we shall see. On top of that, the bond yields probably have nowhere to go but down. I mean, just the facts of the world bonds are... I mean, there's negative yields across NIRP, negative interest rate policy. There's NIRP across the globe here. And it's, I don't know. So I don't see how bond yields continue to pay 3%, but I haven't adjusted that yet. I just want to see how things shake out. So hope this helps. Comment, share this video. If you have any questions, let me know. And don't forget to hit that little bell to be notified. Thanks now.